Okay, got to be honest. Trying to wrap my head around the economy lately is, well, it's like walking into one of those funhouse mirror things.
Yeah, I know what you mean.
You look one way, then another, and nothing feels solid.
And you never know if you should laugh or be kind of freaked out, right? Yeah.
Exactly. You guys sent in a ton of sources about this, and honestly, going through it all was a bit of a funhouse experience itself.
It's understandable people are feeling that way. You're bombarded with numbers, opinions, predictions. It's hard to sort through.
That's why we're doing this deep dive, though, to pick out what really matters from all those sources, especially the stuff that, actually affects decisions you might be making.
Exactly.
So let's jump in. First up, the fallout from the Trump re-election.
Yeah.
Markets went kind of nuts right after like a big rally. But some of the analysis we've got here is saying, hold on, was that optimism a bit premature? Plus, there's this weird trend globally. Seems like incumbent parties, no matter who, are losing vote share.
Yeah, that's interesting.
What's that say about the overall economic mood around the world?
Well, you see, even though the markets, they lurk stability, right? So second Trump term, boom, everyone breathes a sigh of relief. But under that, there was this unease globally.
Yeah, like relief mixed with a bit of, uh-oh, things still feel kind of off.
Right, and losing those votes, it often ties back to money worries. Inflation, immigration, it tells us people weren't exactly thrilled with how things were going, no matter who was in charge.
So a sigh of relief followed by, okay, but what now kind of vibe. And speaking of things not going as planned, what about those sectors everyone said would benefit big time from Trump's policies? Consumer stuff, tech, all that. Did that actually pan out?
It's easy to assume policy equals instant market change, but it's way more complicated.
It's not like suddenly everyone's buying luxury cars just because, right.
Exactly. The market's this giant, messy system. Pinpointing one policy's effect is tough.
Like finding a specific drop of rain in a hurricane.
Yeah, it's all connected.
Okay, fair point. But we can't ignore the Fed, though, right? Trump, he was all about those low interest rates, put a lot of pressure on them. Did that end up swaying things?
Well, the Fed's always walking this tightrope, trying to keep inflation down, but jobs growing. Imagine you're trying to keep this balloon afloat. Too much air, it pops. Too little, it sinks.
So Trump's push for low rates just made that balancing act even trickier.
Definitely added another layer of complexity. Whether they caved to the pressure or not, that's debatable. But rates did stay low during his second term.
Interesting. Okay, next up, we're entering the tariff zone. And this was peak Trump, right? Loved those tariffs, said it was all about protecting American jobs and businesses. But a lot of economists, well, they weren't convinced. It's like two sides of a debate in these sources we got.
Yeah, definitely one of his most controversial moves. The idea is make imported stuff pricier so people buy American-made instead. In theory, it boosts industries here, creates jobs.
But hang on, if imports get more expensive, doesn't that mean the stuff WE buy every day gets pricier too?
That's the counter-argument. Critics said it would hit consumers hardest. Higher prices on everything, clothes, electronics, even groceries.
So my online shopping sprees would suddenly get a lot less fun. Ouch. Didn't tariffs also get kind of shady in the past? I feel like there was something about corruption being a big worry.
You're right to bring that up. Late 1800s, U.S. had a tariff-heavy system, and it was riddled with corruption. Officials favoring certain businesses, rigging the game. The fear is leaning hard on tariffs again might open that door up again.
Not a great precedent to follow, but okay, let's zoom out for a sec. Putting aside the politics, there's this underlying feeling of, like, economic doom that just won't go away. And here's the weird part. The data itself isn't that bad.
Right.
Unemployment's down, growth's steady, but everyone's still gloomy. Why is that?
It's like we're all kind of hungover from the pandemic, economically speaking. Lockdowns, uncertainty, disruptions. It took a toll on everyone's mood,
Yeah, it's like we collectively went through a trauma and haven't quite shaken it off yet.
Right, and then you add in all the talk about AI stealing jobs, which, let's be real, adds to the anxiety. Plus, the media, they love a good crisis, even when things are okay.
Like competition for the most alarming headline ever.
Exactly. It creates this echo chamber of negativity that's hard to escape. It's like even when good things are happening, they get drowned out by the doom and gloom.
Okay, so we've got pandemic hangover, AI fears, media negativity. That's a potent cocktail of doom right there.
Yeah.
But let's do a reality check here. What are some good things happening that maybe we're just overlooking?
Well, for starters, the job market's doing really well. Historically low unemployment, more job openings than people to fill them.
That's actually a good problem to have, right? More jobs than the people to fill them.
Yeah, it's a sign of a strong economy. More opportunities for people to work, improve their lives.
Okay, that's encouraging.
Huh?
What about wages, though? Are they keeping up with the cost of everything going up, or are we all just running in place?
Good news there, too. Wages, especially for lower income folks, have been growing faster than inflation lately. People can actually buy more with their money than before.
Hold on, so we've got global child mortality down, wages are up. This is amazing. Why aren't we hearing about this more often?
That's the negativity bias at work. Bad news just grabs our attention more. But beyond those specifics, living standards globally, they're way up too. Education, healthcare, food, it's gotten better for tons of people, especially in developing countries. Millions are lifted out of poverty. That's huge.
It's like we're so focused on what could go wrong, we miss what's going right.
Exactly. We got to celebrate those wins too.
Okay, good point. But speaking of things that could go wrong, let's get back to something you mentioned earlier. Passive investing, index funds, ETFs, tracking the S&P 500, all that. Everyone and their grandma seems to be doing it these days. Even Warren Buffett's having a hard time picking individual stocks. So everyone's piling into these supposedly safe options.
Yeah, passive investing has become super popular, and for good reason, right? It's low cost, easy, gets you in the market. But there are risks that people don't always think about.
Lay it on me. What are we missing? What's the catch?
One big one is this thing called concentration risk. Imagine the S&P 500 is like a pizza. Now, Apple, Microsoft, Amazon, they're taking up most of the slices. If one of those goes bad, your whole pizza's messed up.
Even though it feels like you're spreading your risk, you're actually just betting on a few big companies to do well.
Exactly. And they're all interconnected too. So if one stumbles, the whole tech world could take a hit, and your portfolio along with it.
Okay, I see how that could be a problem. But those tech giants, haven't they been killing it for years? What makes us think NW is the time to worry? It's not like they'll just vanish overnight, right?
True, they have done well. But past performance doesn't guarantee the future, and there are signs things might get tougher for them.
Okay, like what?
Well, their valuations are super high right now. It means investors are already betting they'll keep growing like crazy. If they don't, those stock prices could plummet.
So it's like everyone's assuming these companies will just keep getting bigger and bigger, and if they don't, the whole market could tank.
That's one way to look at it. Plus, there's the regulation factor. Governments are getting more and more concerned about big tech, both here and overseas. Their power, data privacy, all that. New rules could limit their growth or even, force them to break up. That'd shake things up for sure.
So we've got concentration risk, super high valuations, and the government breathing down their necks.
Mm-hmm.
Anything else to worry about with the S&P 500? It's starting to sound like a minefield out there.
Oh, and we can't forget about interest rates. Low rates make investors more likely to take risks, which pushes stock prices up.
Mm-hmm.
But when rates go up, and they always do eventually, that can make stocks seem less appealing. People might start pulling their money out.
So are you saying that the S&P 500's amazing performance lately, maybe it was all thanks to those super low interest rates? Like, the party's about to end.
It's definitely a possibility. If rates rise a lot, we could see a market correction, and the S&P 500 would feel it. Not necessarily the end of the world, but something to keep in mind.
Okay, so the mighty S&P 500, the darling of passive investors everywhere, might not be as safe as we thought. What's a passive investor to do then?
First off, don't panic. Investing is a long game. Short-term swings are normal. Look at your portfolio, make sure it matches your risk tolerance, your goals. If you're heavily in the S&P 500, think about branching out. Small cap stocks, international stocks, even bonds.
So basically, don't put all your eggs in one basket, even if that basket is the S&P 500.
Exactly. Spread that risk around. That's how you ride out the market's ups and downs without losing your shirt.
Speaking of writing things out, let's shift gears for a bit and talk about the big question on everyone's minds: the future of the economy. We've touched on some worries and risks, but are there any reasons to be hopeful? Any light at the end of the tunnel?
Despite all the challenges we've talked about, there are actually several reasons to be cautiously optimistic about the future. For one, technology keeps advancing at an incredible pace. It's creating all sorts of new opportunities for growth and productivity. Look at how tech has changed healthcare, education, transportation, finance,
So maybe those robots everyone's scared of might actually end up making things better.
It's possible. Historically, new tech leads to new jobs, a stronger economy, and tech keeps evolving, so we can expect even more innovation, more opportunities down the line.
Okay, so technology's on our side. What else is working in our favor?
Well, humans are remarkably resilient. Throughout history, we've faced wars, pandemics, economic disasters, and we always bounce back stronger. It's like we're hardwired to adapt, innovate, find solutions.
That's actually really reassuring to hear. But let's be real. The economy isn't just about tech and good vibes. What about those big structural problems that are holding us back? Income inequality, climate change, all that. Those seem pretty daunting.
They are serious issues, no doubt. But even there's hope. More and more people are realizing that a healthy economy and a healthy society, they go hand in hand. They're demanding change.
Like investing in renewable energy, social impact companies, all that.
Exactly. People are putting their money where their values are, and that's driving real change. It's a reminder that we're not just passengers on this economic ride, we can steer the wheel too.
I love that. It's easy to feel powerless with all these big economic forces at play, but you're right, we do have choices. But before we get too philosophical, let's bring it back down to earth and talk about something that affects us all every day, our own personal finances.
Let's get personal.
So what are some key things our listeners should be thinking about, given all this economic uncertainty we've been talking about?
Well, having a solid financial plan is more important than ever. Set clear goals, track your income and expenses, build that emergency fund. It's like having a roadmap for your money helps you navigate the unexpected bumps along the way.
So like a financial GPS. It's telling you where to go and helps you avoid those financial potholes.
Exactly. And speaking of potholes, we talked about market swings, potential downturns. How can people prepare for that kind of stuff? It's easy to freak out when the market goes haywire.
Yeah, totally.
Diversification is key. Remember, don't put all your eggs in one basket. Spread your investments around different types of assets, different parts of the world. That way, if one area tanks, the others might be okay and can help balance things out.
Makes sense. So even if one part of my portfolio is taking a hit, other parts might be doing okay, and that helps cushion the blow.
Exactly. It helps you ride those waves without wiping out completely.
Speaking of things that can wipe you out, what about debt? Is now a good time to be paying that down, or should we be taking advantage of low interest rates to invest? There's so much conflicting advice out there, it's hard to know what to do.
There's no one-size-fits-all answer. It really depends on your situation, your risk tolerance. High-interest debt, like credit cards, that should be a priority to pay off ASAP. It's like a financial anchor weighing you down. Low-interest debt, like student loans or mortgage, you might be able to manage that while still investing for the long term.
So it's all about finding the right balance for you between paying down debt and investing for the future.
Exactly. And that balance will be different for everyone. The key is to be aware of your own financial situation and make choices that align with your goals and your comfort level with risk.
Okay, so we've got financial planning, diversification, managing debt. Any other financial tips for navigating this uncertain world? It's a lot to keep track of.
One more thing I'd emphasize. Stay informed and be flexible. The economy is always changing, so what worked in the past might not work in the future. Keep learning, stay curious, and don't be afraid to adjust your approach as needed. Sometimes you got to change course along the way.
I love that. It's a reminder that this is a journey, not a destination, right? We're always learning, always adapting to the financial landscape as it shifts. All right, we've covered a lot in this first part of our deep dive.
We have, haven't we?
But before we move on, I want to touch on something we keep coming back to. This disconnect between the actual economic data and how people feel about the economy. It's like we're living in two different realities, one based on numbers, the other on feelings.
It really is a paradox. By a lot of measures, things are good economically. But people feel stressed, worried about the future, like we're surrounded by abundance, but still feel a sense of scarcity.
So how do we bridge that gap? It's like we're speaking different languages.
I think we need to remember that the economy isn't just about numbers. It's about people, their lives, their hopes, their dreams. And right now, a lot of people are feeling left behind, unsure about what's coming next, like the system's not working for them.
So it's not just about making the GDP number go up. It's about making an economy that works for everyone,
Yeah,
where everyone benefits.
exactly. It's about well-being, sustainability, shared prosperity, an economy that works for the many, not just the few.
That's a powerful idea. It's a reminder that we can build a better economic future, but it's going to take a shift in how we think, a commitment to fairness and equality. Okay, we're going to take a quick break here, but when we come back, we'll continue this deep dive with even more insights and analysis to help you navigate this wild world of economics. Stick with us.
Welcome back. Before we jump ahead, I keep thinking about that economic pessimism we were talking about. It's fascinating, isn't it?
Yeah, totally.
Even when the numbers look decent, people still feel gloomy about money stuff. It's like this disconnect between, like, the reality and how it feels.
Tell me about it. I catch myself doing that too. I know logically things aren't that bad, but there's still this underlying dread.
Makes sense, though, when you think about how our brains work. We're wired to react strongly to changes, especially when it hits our wallets.
Like gas prices going up a few cents and suddenly everyone's panicking.
Exactly. Grocery prices, too. Every time you shop, it's a reminder that things cost more. It's immediate. You feel it right then. But long-term trends, like, say, child mortality going down globally, that's huge positive news, but it doesn't hit us the same way. It's gradual, so we don't feel it as strongly.
So we're wired to focus on the immediate, ouch, this is more expensive stuff, even when bigger, slower, positive changes are happening.
It's like that saying, one robin doesn't make a spring. We're fixated on the winter of rising costs, even while the spring of progress is slowly unfolding.
Love that analogy. So it's not just the pandemic hangover, AI fears, and the media being all doom and gloom. It's our own WN brains making us extra sensitive to the negative stuff.
Exactly. We've got this built-in negativity bias. It's been with us since, like, caveman days. Our ancestors, they survived by focusing on threats, right? So we're naturally tuned to scan for danger.
So even though we're not dodging saber-toothed tigers anymore, our brains are still looking for them, metaphorically.
Exactly. Always looking for that thing that might go wrong.
Okay, starting to get why that economic pessimism is so sticky then. But let's do a reality check. What are some good things happening economically that maybe we're missing in all the gloom? Stuff that should give us a little more hope.
Well, the job market is pretty strong right now. U.S. has really low unemployment, historically speaking, and there are actually more jobs than people to fill them.
Wow, that's kind of a good problem to have, isn't it? More jobs than people to fill them.
It is a good problem to have. It shows a healthy economy, lots of opportunity for people to work, earn more, improve their lives.
That's encouraging.
Mhm.
But what about wages? Are those keeping up with the cost of living, or are we all just, running on a treadmill, working harder but not actually getting ahead?
More good news there. Wages, especially for folks who were earning less before, have been growing faster than inflation in recent years.
So people's buying power is actually going UP. They can afford more stuff.
Exactly. Things are getting more expensive, sure,
Hmm.
but people are also earning more, so they're not falling behind as much as it might seem.
Okay, wait. So we've got global child mortality down, wages are outpacing inflation. This is fantastic. Why don't we hear about this stuff more often?
It's that negativity bias again, unfortunately. Bad news is just sexier. But beyond those specific examples, we're also seeing huge progress in how people live around the world. Education, healthcare, food security. It's improved dramatically for millions, especially in developing countries.
It's not all doom and gloom.
Not at all. There's a lot to be optimistic about, even if the headlines don't always reflect that.
It's a good reminder to focus on the bigger picture sometimes, not just the immediate stuff that stresses us out. Okay, but speaking of things that could stress us out, let's get back to something you mentioned earlier, the potential risks of passive investing, especially that concentration risk with the S&P 500. You were saying it's like a pizza where a few companies are hogging most of the slices. What does that actually look like in the real world?
So picture this. You've got an S&P 500 index fund. That's basically a basket of the 500 biggest publicly traded companies in the U.S., right? Now, inside that basket, you've got a handful of these tech giants: Apple, Microsoft, Amazon, Google, and so on. And they make up a huge portion of the overall value of that whole index. We're talking trillions of dollars concentrated in just a few companies.
Okay, so if one of those tech giants has a bad quarter, my supposedly diversified portfolio takes a hit. It's like the whole pizza gets soggy because one slice went bad.
That's the risk. And what makes it even riskier is that a lot of these companies are interconnected. They compete with each other in some areas, but they also depend on each other in others. So a negative shock to one of them could ripple through the whole tech ecosystem, dragging down your portfolio with it.
Okay, I get how that could be a problem. But these tech companies have been doing incredibly well for years. Why should we be worried? And now to be you. It's not like they're going to disappear overnight.
True, they've had a good run. But past performance isn't a guarantee of future success. And there are a few things that could make things tougher for the tech sector going forward. One thing is their valuations are really high right now. Basically, investors are betting that these companies will continue to grow at a crazy pace. If that growth slows down, their stock prices could drop significantly.
So it's like everyone's assuming these tech companies will just keep getting bigger and bigger, and if they don't, the whole market could take a hit.
That's one way to look at it. Plus, there's the whole issue of regulation. Governments around the world are starting to look more closely at big tech companies. They're concerned about their power, their data privacy practices, potential anti-competitive behavior. New regulations could really limit their growth or even force them to break up, which would definitely shake things up in the market.
So we've got concentration risk, high valuations, and the government breathing down their necks. Is there anything else to worry about when it comes to the S&P 500? It's starting to sound like a bit of a minefield.
Don't forget about those interest rates we were talking about earlier. When interest rates are low, investors are more willing to take risks, which pushes stock prices up. But when rates start going up, and they always do eventually, that can make stocks seem less attractive. Investors might start shifting their money to other assets, which could lead to a drop in stock prices.
So are you saying that the S&P 500's amazing performance lately, maybe it was partly because of those super low interest rates, like the party's about to end?
It's a possibility. If interest rates rise significantly, we could see a correction in the market, which would definitely impact the S&P 500. It's not necessarily a doomsday scenario, but it's something investors need to be aware of.
Okay, that's making me think. So the mighty S&P 500, the darling of passive investors everywhere, might not be as safe as we thought. What's a passive investor to do?
First off, don't panic. Investing is a long game. Short-term ups and downs are normal. The important thing is to take a look at your portfolio and make sure it aligns with your risk tolerance and your financial goals. If you're heavily invested in the S&P 500, it might be a good idea to diversify a bit. Look into small cap stocks, international stocks, maybe even bonds.
So don't put all your eggs in one basket, even if that basket is the S&P 500.
Exactly. Spreading your risk around can help you ride out those market fluctuations without losing your shirt. And speaking of diversification, remember those niche ETFs we were talking about earlier?
Yeah, the ones that are super focused on like one specific industry or trend.
Right. Those can be tempting, especially if they're focused on something that's hot right now. But the more specialized an ETF is, the less diversified it actually is. It's kind of like putting all your money on a single number on the roulette wheel.
If that number doesn't come up, you're out of luck.
Exactly. If you're thinking about investing in a niche ETF, make sure you really understand what you're getting into. Look at the specific companies it holds, understand the risks involved, and think about how it fits into your overall investment strategy. Don't just chase the hype without considering the potential downsides.
Okay, that's good advice. Now, let's talk about the future of the economy. We've talked about a lot of the anxieties and potential risks, but are there any reasons to be optimistic? Any signs of light at the end of the tunnel?
Even with all the challenges we've talked about, there are some reasons to be cautiously optimistic about the future. One big reason is technology. It just keeps advancing at an incredible pace, which creates all sorts of new possibilities for growth and productivity.
So maybe those robots everyone's worried about might actually help us out in the long run.
It's possible. Throughout history, technological advancements have led to new jobs, new industries, and a stronger economy. And technology keeps getting better, faster, smarter. So we can expect even more innovation and even more opportunities in the years to come.
Okay, technology is the point in the optimism column. What else is working in our favor?
Well, another positive factor is the resilience of the human spirit. Throughout history, we've faced all kinds of challenges, from wars and pandemics to economic depressions, and we've always found a way to overcome those challenges and emerge stronger on the other side. It's like we have this innate ability to adapt, innovate, and find solutions to even the most complex problems.
That's actually really reassuring. But let's be real, the economy isn't just about technology and positive thinking. What about the big structural issues that are holding us back, like income inequality, climate change? Those seem like pretty daunting challenges to overcome.
You're right, those are serious issues that need to be addressed. But even there's reason for hope. There's a growing awareness of these issues, which is driving innovation and investment in solutions. More and more people are recognizing that economic sustainability and social responsibility go hand in hand, and they're demanding change.
Like the whole push for renewable energy
Right.
and socially responsible investing.
Exactly. People are aligning their money with their values, and that's making a difference. It's a reminder that we have the power to shape the future of the economy through our choices and actions.
I love that. It's easy to feel powerless when you think about the big picture. But you're right. We do have agency. We can make choices that make a difference. Okay, but before we get too philosophical, let's bring it back down to earth and talk about something that affects all of us every day.
Yeah.
our personal finances.
Let's get personal.
So, what are some key things our listeners should be thinking about, given all the economic uncertainty we've been talking about?
One thing that's more important than ever is having a solid financial plan. That means setting clear financial goals, tracking your income and expenses, and building an emergency fund. It's like having a roadmap for your money. It helps you stay on track and navigate unexpected challenges along the way.
So like a financial GPS, it helps you get where you want to go and avoid those financial potholes along the way.
Exactly. And speaking of potholes, we've been talking a lot about market volatility and the potential for economic downturns. How can people prepare for that kind of stuff? It's easy to feel overwhelmed and helpless when the market goes crazy.
Yeah, it can be really scary.
The diversification is key. Remember that don't put all your eggs in one basket advice. It applies here too. Spread your investments across different types of assets, different sectors of the economy, and even different geographic regions. That way, if one area of the market takes a hit, the others might be okay, and that can help to balance things out.
So even if one part of my portfolio is losing money, other parts might be doing well, and that helps to soften the blow.
Precisely. Diversification helps you ride out the waves of market volatility without losing your shirt. And speaking of things that can wipe you out financially, what about debt? A lot of people are wondering if now is a good time to be paying down debt or if they should be taking advantage of low interest rates to invest. It's a tough decision, especially with all the conflicting advice out there. There's no one-size-fits-all answer to that question. It really depends on your individual circumstances and your risk tolerance. Generally speaking, high-interest debt, like credit card debt, should be a priority to pay down as quickly as possible. It's like a financial anchor weighing you down. But low-interest debt, like student loans or a mortgage, might be manageable while you're also investing for the long term.
So it's about finding the right balance for you between paying down debt and investing for the future.
Exactly. And that balance will be different for everyone. The key is to be aware of your own financial situation and make choices that align with your goals and your risk tolerance.
Okay, that makes sense. So we've covered financial planning, diversification, managing debt. Are there any other financial tips for navigating this uncertain economic landscape? It's a lot to keep track of.
One more thing I'd emphasize is the importance of staying informed and adaptable. The economy is constantly changing, and what worked in the past might not work in the future. So keep learning, stay curious, and don't be afraid to adjust your strategy as needed. Sometimes you have to change course along the way.
I love that. It's a reminder that this is an ongoing journey, not a destination. We're always learning, always adapting to the financial landscape as it shifts. Okay, we've covered a lot in this part of our deep dive. It's been really insightful.
It has been, hasn't it?
But before we wrap things up, I want to touch on something that's been a recurring theme throughout our conversation. This disconnect between economic data and how people feel about the economy. It's like we're living in two different realities. One is based on numbers and statistics, and the other is based on feelings and perceptions.
It's a really interesting paradox, isn't it? By a lot of measures, the economy is doing pretty well. But a lot of people are feeling anxious and pessimistic about the future. It's like we're surrounded by abundance, but still feel a sense of scarcity.
So how do we bridge that gap? How do we get those two realities to line up? It's like we're speaking different languages.
I think it starts with recognizing that the economy isn't just about numbers and statistics. It's about people, their lives, their hopes, their dreams. And right now, a lot of people are feeling left behind, uncertain about the future, and disconnected from the systems that are supposed to be working for them.
So it's not just about boosting GDP or lowering unemployment. It's about creating an economy that works for everyone, where everyone has a chance to thrive.
Exactly. It's about well-being, sustainability, shared prosperity, an economy that works for the many, not just the few.
That's a really powerful idea.
Hmm.
And it's a reminder that we can build a better economic future. But it's going to take a shift in mindset, a commitment to fairness and equality. Okay, we're going to take a quick break here, but when we come back, we'll continue our deep dive with even more insights and analysis to help you navigate this wild world of economics. Stick with us. And we're back for the final part of our deep dive. We've been through a lot today, haven't we?
We have.
But hopefully by now, you're feeling a bit more, equipped to deal with all this economic stuff.
Yeah, knowledge is power, right?
Exactly. And one thing that keeps striking me is how much of this whole economic picture is tied to psychology. It's not just the numbers themselves, it's how we feel about them.
Oh, absolutely. It's all about interpretation. Same data, different person, totally different reaction.
Remember how we talked about the media loving to focus on the negative? It's like we're addicted to economic anxiety at this point.
And that anxiety, it can actually make things worse, like self-fulfilling prophecy kind of thing.
So if everyone's convinced a recession's coming, they might start spending less, investing less, which could actually cause a recession.
Exactly. Our collective mindset can literally shape the economy.
It's kind of freaky when you think about it.
Yeah.
So how do we break out of that cycle? How do we go from doom and gloom to, I don't know, a more realistic and, dare I say, optimistic outlook?
Honestly, it starts with awareness. You got to recognize those mental biases we all have, the negativity bias, recency bias, all those mental shortcuts our brains take.
So basically, we need to be more aware of how we think, especially when it comes to money. Like, question those the sky is falling narratives.
Exactly. Don't just blindly accept what you hear. Dig deeper, challenge your assumptions, and most importantly, get different perspectives. Don't rely on just one news source or one expert. Remember the Goldman Sachs thing?
Oh, yeah, when they said the S&P 500 was going to tank, not exactly what you want to hear when you're trying to plan for the future.
Right. But we also talked about other experts who weren't so pessimistic, especially about tech in the long run. It shows that even the smartest people disagree about the future. Nobody has a crystal ball.
So what's a regular person who's not an economics guru supposed to do? It's tempting to just, like, bury my money in the backyard and hope for the best.
Well, instead of burying your money, focus on what you can control. You can control how much you save, how much you spend, how you invest.
So less about predicting the unpredictable and more about building a solid financial base that can handle whatever comes my way.
Exactly. Think of it like building a house. Strong foundation, sturdy walls, a roof that can handle a storm. Trying to time the market, chasing hot stocks, that's like building on sand. Eventually it'll collapse.
Okay, I like that analogy.
Yeah.
But for someone just starting out, where do you even begin? There's so much info out there, so much jargon. It's overwhelming.
It can be, yeah. Don't get discouraged, though. Start with the basics. Learn about different types of investments. Stocks, bonds, real estate. Understand risk and return, how diversification works. There are tons of great resources out there. Look for trustworthy financial websites, books by experts, courses from reputable institutions, and don't be afraid to ask questions. There are people who want to help you.
That's great advice. Feeling in control of your finances is so important. All right, as we wrap up this deep dive, let's recap some key takeaways. We talked about Trump, tariffs, the emotional side of economics, the risks and rewards of investing. It's been quite the journey.
It has. And what I'm taking away from all this is resilience. Being resilient when things are uncertain, being resilient in our financial plans, and most importantly, being resilient in how we think about all this stuff.
Couldn't have said it better myself. So to sum it up, and navigate this crazy economic world, we got to stay informed, be ready to adapt, and focus on building that strong financial foundation. And remember, even when things seem chaotic, we do have the power to shape our own financial futures. That's pretty empowering, right?
It absolutely is. And remember, investing isn't just about making as much money as possible. It's about aligning your money with what you believe in, what you want to achieve. It's about taking control and building a life you love.
Beautifully said. Well, folks, that's our deep dive into the wild world of economics and finance. We hope you found it helpful, maybe even a little bit inspiring. Remember, the journey to financial well-being is a marathon, not a sprint. Keep learning, keep growing, and keep asking questions. Until next time, happy investing.